Here's how I went from zero to an £8 million property portfolio. So I'm going to cover how I started the business with only £3,000. It doesn't cost that much money to get started. I'm going to show you how to buy a property and to get all of your money back, and break down step by step how I built an £8 million portfolio. So let's get started. I started this as a side hustle alongside a 70-hour-a-week high-level role doing what is called rent-to-serviced accommodation. I was renting 1 to 4 bedroom properties in the northeast of England, ranging from £500 to £1,500 a month. So you get the professional pictures done, you furnish the property, and when I put this onto Airbnb, I got bookings like this. So if I rent a property for £900 a month and I rent it out for one night at a time, why are people willing to pay me double, if not more, to what I am paying? Hassle-free, convenience, amenities, no furniture costs. If you are coming to Newcastle, you don't have to go and rent a property for 6 months. You can rent it for that exact period of time, and therefore people are willing to pay a premium for this service, just like they do with hotels. And this is essentially what I started doing in Newcastle, Gateshead, Sunderland, Durham, Darlington, and for the last few years in Dubai, as this model works in most locations. The big benefit of this strategy is that it doesn't cost too much money to get started. You need about a 6-week rent advance, you need a deposit, you pay for some furniture, and that's about it. So I really doubled down on this for about 12 months, and then I expanded my rent-to-rent game to building a portfolio of assets that I own. Using the cash I was generating from my rent-to-rent portfolio, plus private investor money, which I'll come on to shortly and show you how to use other people's money to build your wealth. Every strategy has its own benefits. The benefit of rent-to-rent is you don't need much money and you can get started very quickly. The benefit of a portfolio is it will appreciate in value over the years. You have full control, and in most cases, you will earn 3 times more net income from it every single year. And this brings me on to my next question. How much does it cost to buy a £250,000 house? So you've got a 25% deposit, so that's £62,500. You've got £7,500 stamp duty. So if you've got Knight Frank's stamp duty calculator, type in 250,000 and then make sure you've got this box clicked because we are buying a second home. Click calculate and it will give us our effective stamp duty, 7.5 grand. Just as a side note here, you want to try and purchase properties under 250,000 because it will reduce your entry costs. As you can see here, the stamp duty threshold of 8 and 13% as you push past the £250,000 mark starts to really eat into your profit. Legal fees are going to be approximately £1,500. So if we add all that up, it comes in at just over £70,000. So my aim here is how do I reduce that as much as possible so that I can buy as many properties as possible with one pot of money. Now, if you're fresh into the property space, you might be thinking, well, don't I need to work hard and save up a 25% deposit and then repeat this over and over to build a property portfolio? You would not be alone with this thought because I was exactly the same prior to 2019. In fact, just before this date, I just couldn't figure out in my head how you could buy more than one property per decade, as it would take so long to save for the average person to execute this model. So let me introduce you to the BRRR model. Based in the northeast of England, I bought this house in Gateshead. This is the kitchen, this is the bathroom, and these are the bedrooms. And this is how I turned it into a 5-bed house to add value, which is the important step that I'm going to come on to shortly. I moved the kitchen from the ground floor to the middle floor to form a kitchen living area. I then turned the living room, as you see on this floor plan, into an ensuite bedroom. If you have no experience in property development, then this is an easier way to get started than, say, a loft and garage conversion, extensions under permitted development, or larger enhancements that require full planning permission. You also don't need to do this in the majority of cases, and my best projects have always been the quickest ones. Kitchens, bathrooms, carpets, and decorations can usually add enough value to execute this strategy, and it also means your property is generating revenue quicker as well, which is why the majority of us are doing this, right? So I bought this property for $95,000. I know a 4-bed house for $95,000 sounds crazy money, but it was a repossession sale from a bank and it was pre-COVID prices, so they were slightly lower. That being said, this strategy still very much works post-COVID, so stick with me. The total cost to get it live was $36,916. That's everything: the refurb, the furniture, the stamp duty, the legals, etc. In the space of 6 months, this property was revalued at $160,000. At that stage, I refinanced the property. What that means as a property investor is essentially you're going to get a loan of 75%. Now, To purchase this initially, I took out a bridging loan at 70% of the purchase value, which in this case is $66,500, less arrangement fees, which was 2% of the loan amount, so $1,330. After the works are done, I got it valued for $160,000 by a specialist serviced accommodation mortgage lender. So it's gone up in value by $65,000 in less than 6 months. With the increased valuation from the lender, I get a 75% loan to value mortgage on the property, which is $120,000. Less the arrangement fees, which in this case was $1,250 for the new mortgage. Now, of course, that is a higher amount because you know the property is now worth considerably more. So when you get the second mortgage, you get a lot of your money back in the pot. It has only cost me £134,496 for the entire project, which is now worth $160,000. So my profit would be £25,504. However, this is where the magic happens. Out of my own pocket, initially, remember that I paid 30% deposit for the bridging loan, which was $28,500, plus the refurb, legal, taxes, etc., which remember we calculated at $36,916. Arrangement fees together were $2,580, so the total cash injected was $67,996. Now let's circle back to the mortgage I got after the refurbishment was complete. Remember, the bank paid me $120,000. I owe the bridging company $66,500. So after I pay that back, I'm left with $53,500. Invested $67,996. Got back $53,500, which means out of the $67,996 I paid out of my own pocket, I have now reduced this to only $14,496. I now own a property with $25,000 profit in it, and running it as serviced accommodation, it will cash flow me north of £24,000 a year net. Now, by the way, with these examples, to make the most amount of money with property, you do need to buy these with a discount. And these are the best tips when it comes to getting a discount. You want to read the book $100 Million Offers by Alex Hormozy. I use an app called Blinkist to read or skim through the core content, as it means I can consume more in less time and move forward quicker. So let's take a look. There's one section that we really need to dive into, which is section 4 around urgency and scarcity. The best negotiators know how to leverage scarcity and urgency when creating deals. Humans crave what they can't have. Entrepreneurs who recognize this see their profits skyrocket, not by changing their product or service, but by changing how they present it. Urgency is scarcity's partner in crime. Where scarcity stirs up desire based on limited quantity, urgency generates desire based on limited time. Humans aren't logical creatures, so don't sell to rationality. Instead, use these psychological insights to whip up the logic-defying demand your Grand Slam offer deserves. Now, in the property space, we create urgency and the fear of missing out in several ways. Let's say you want to buy my deal and it was advertised for £105,000. What you don't do is when your offer gets rejected at $90,000 is say, well, I'll meet you in the middle and I'll pay $97,500 and we'll make something work for us both. You can use time to create pressure. By establishing deadlines, you can force your counterpart to make rash decisions because they are afraid of losing something in the future. So when you speak to the seller or the agent in this case and you say, hey, I'm looking to buy a property by the end of the month. I'm looking at 6 other properties. If I can get this offer accepted by the month, I'll move forward with it. If not, I'm going to take one of the other ones if this doesn't get accepted. Now you have established a deadline and created time urgency, plus the fear of missing out for the seller. They know you have to make a decision by the end of the month. That's likely to create more pressure for them, and you might get the deal through as opposed to meeting in the middle or your second offer rejected. Also, never go up in big increments. This is normal for poor negotiators. Every time you go up, the seller will likely come down. If you go up in smaller increments than them, then you will buy the property at a better price. I personally, no matter how big the deal, go up in increments of no more than £2,000. And I always use a random number, say 1672, as it makes it sound like we have really crunched our numbers and we're at our absolute maximum to buy the property. I mentioned earlier how much it costs to buy a property worth £95,000, and that was only $67,996. So if you only have £150,000 to invest this way, you can have 2 or 3 projects on the go at the same time, as opposed to one investment property if you were buying it for cash. As your money refinances out, you can buy again and again and again. Sticking with the maths above, you could purchase roughly 10 properties with that one pot of $150K, and that doesn't even factor in the extra revenue you will create to also top the pot back up. It's a very powerful investment strategy. Now, you might be thinking, I don't have $150K, I don't have $69,996. Stick with me. There are ways to navigate this and still become a property portfolio investor over the next few years. So the first one I bought was a 2-bed house, and I didn't do much to it as the seller was motivated, so this was a distressed sale. The next property was a tired property after an elderly lady was moved into a care home after living there for almost 20 years. On the same street, I spotted another rundown property when we were in and out of the elderly lady's project, so I pulled the land registry and got in touch with the owner direct, and I put a deal together. This was a cashback deal as the investor was in London and just wanted out, so a great find and a very worthwhile £3 spent obtaining the land registry data online. Next up, I bought a 3-bed in an auction, then a 3-bed semi in another auction before moving on to a few apartments, which I've since sold, so if you follow my channel, I'll be doing another video on why in the near future. This pattern continued. I would scroll Rightmove for properties every night after work and I'd get viewings booked in where I could. So I'd go to Rightmove and I'd put in my parameters, whatever it might be. So say 3 beds to 5 beds, might have a maximum price range of that £250,000 mark. And I might only want to buy houses. Again, I've explained that I'm going to come on to another video why I've sold my apartments. And then what we're going to do is just have a look. Now there's various different filters. You can go highest price, you can go oldest listed, newest listed. It doesn't really matter. There's opportunity everywhere. I would say go through every single listing. As I'm searching through here, what I'm looking for is properties that look dated. So they've got old kitchens, old bathrooms. Now you might see this little extension here. This is called Property Log. It's a Chrome extension and it shows you if properties have been reduced in price when they were listed. So the more entries here could potentially spot a motivated seller. So we're just looking for properties here that are, there we go, a bit run down. They look very old. They've got old kitchens, they've got old bathrooms, and there's going to be opportunity in these properties. As we're scrolling through, we're making a list, we're putting it on our deal calculator, and then once we've got our list of properties to view, we start making the phone calls and booking in the viewings. Now you might be thinking, well fine, that's all good and well, but it still needs £50,000, £30,000, £40,000, and if you're in a situation where you don't have the £40,000, then you still have a bit of an issue, right? Here's a bit of a simple solution. The example I showed you earlier was a bit on the lower end. The average is between 150 and 250k, and naturally they create more profit per deal. Let's assume you're making 50k development profit per deal. If you did one of these projects and you sold it, you would make 50 grand and then get your initial pot of money back. If you then did another one, this time you held it, your money left in is 50 grand. So essentially you do one, you flip it, you get the money, you do another one and you hold it. So if you keep flipping, holding, flipping, holding, flipping, holding, then you're in a situation where it's not really costing you any money because you can keep doing more and more without your pot being depleted every single time. The only issue with this is the fact that it would take a long while to build a portfolio. Let's say it takes 9 months to do a project. Well, if you flipped one, that's 9 months. If you then did another one, at best, that's 18 months. Now, this is where I had to scratch my head and figure a better way out, as I wanted to move a lot quicker than 2 properties every 2 years. Private money lenders. Unlocking the second biggest secret in BRR after the refinancing element. You might not think it now, but accessing money is a lot easier than you think, as wealthy people actually have a problem. And that problem is they struggle to deploy their funds into safe and profitable ventures which will give them a return above inflation, i.e. banks are no good for them to store their cash anymore. Now your next question is more than likely, they are wealthy, so obviously they are savvy, so why would they not just do it all themselves? Well, first up, they don't have the knowledge. Not everybody knows how to invest in property. Secondly, they are more than likely running other business ventures, so don't have the time. Thirdly, wealthier people tend to be older as you amass wealth over time. Obviously, some break the common trend, but typically you get wealthier as you get older, and as such, they simply do not have the motivation to learn a new skill set and put the work in to pull this off time and time again. This week alone, I've raised over 1 million in investor funds. My issue right now is deploying it and finding the deals to ensure I don't get the money stuck, as the investors want their money back. Now, the options you have with the investors vary, and I have deployed them all, but in the main, you have 3 options for them. Number 1, straightforward lending for a return, typically between 8 and 12%. You might pay more for your first deal. To make it secure, you put them as a charge on the title deed. Number 2, you share the equity and or cash flow profit of the project or exchange it if you get the money stuck on option 1. And number 3, you joint venture with them and they bring the money to the table. You do all the sourcing, the project management, the operating of the business once the property's alive, and you share the spoils. Typically in favor of the investor because they are bringing the money. The great thing about investors with money is they are usually open-minded and will consider options to suit both parties, as this really is a true win-win solution. As well as the private funding side and building the assets under management, I was also able to purchase a fair few properties of my own with the profit I was building up from my investor purchases and also my rent-to-rents. I acquired 21 rent-to-rent properties in the first 7 months, and as a one-man band with barely any operational overheads, the profit margins were high. As I remained in my full-time job at this stage as well, I had no requirement to pull any money out, so it was all reinvested into buying assets. I would highly recommend reinvesting as much as you can for the first few years. Now, the amount I would make would depend on the size of the property and the ownership. I pulled together this sheet which shows the average profitability of my rent-to-rent portfolio and also my owned portfolio based on bedroom size, just to give you an idea of roughly what you should be able to make as a net cash position by finding the right stock. So as you can see, it ranges from 350 on a 1-bed rent-to-rent deal and goes up to north of 3,000 for larger houses that I own. I do actually have some houses that are doing 5-6k a month, but on average, this is how it plays out, and this tends to be my average rent-to-rent property after running the portfolio for nearly 4 years now. This is how I took the portfolio to multi-millions and continue to grow it every month still. As always, any questions, pop them in the comments. Don't forget to subscribe and make sure you watch this video.